Markets bounce back, regional banks make headlines again, and year end tax planning opportunities are on the radar. In today's episode, we'll break down what's behind last week's rebound, why some smaller banks are under pressure, and how to be proactive in your portfolio as 2025 winds down. We'll also tie this back to biblical principles of stewardship and what it means to stay disciplined, patient, and intentional, even when headlines make us a bit anxious.
Yeah, welcome to the Wealth and Wisdom Podcast, where intentional planning meets eternal perspective. It's October 20th. I'm Brian Cochran, joined by my associate, Leonida. We're so glad you took the time to join us today. And last week, a good week in the markets, right, Cole? So a little bounce back after some choppy trading. We saw volatility tick up 2 weeks ago for the first time in a while. But there were still some scary headlines blended into that positive week. So, Cole, what did we see in terms of performance across the major markets last week?
Yeah, last week it was a really nice rebound after that scare 2 Fridays ago. The S&P 500 was up about 1.7% last week. The tech-heavy Nasdaq was up about 2%, and then small caps had a really nice rebound, up about 2.5% last week. And this is all in the middle of a continued ongoing government shutdown. I met with several clients over the last few weeks that have been directly impacted with that. And part of what we look at on a weekly basis is data. Brian, how's that affecting the data that we're seeing?
Yeah, some of the data we get comes from private organizations, that go out and survey employment data or what's going on in housing, for example. But a lot of our data comes from organizations that are operated by the federal government, funded by the federal government. So we kind of had a drought. Some data is being delayed, some's not showing up at all. So it sort of impacts the way we look at things because we like to look at that data. But maybe one of the lessons learned here is, hey, life goes on, the markets continue, companies are still out there producing products and services and making profits and announcing their earnings. A lot of what drives the market is going to happen whether the government's open or not. So that's kind of reassuring. I saw some commentators last week talking about that if there's anything we're learning from this is maybe the government's not so essential, which again is easy to say if you don't work there. We've had a few really interesting conversations with folks who are a couple weeks into this no pay and struggling. Thankfully, most of our clients are really financially secure with good cash reserves to survive a couple months or a couple paychecks that they might miss. It's been an interesting time through that whole government shutdown, but I sort of miss it, Cole. I don't know about you, but first thing I do every morning is I, get my day started, and as I'm settling in for breakfast, I pull up the economic data that comes out usually at about 6:30 my time, and that's not part of my morning anymore.
Yeah, what are you going to do with all that time? Maybe we can all kind of reset and get back to the making the main thing, and start our morning in the Word. I know that that's a habit that my wife and I try to be in, but sometimes easier said than done, especially when there's always something seemingly urgent or important to look at, especially in our line of work. We want to stay ahead of all that. And one thing that is coming out this Friday, whether the government's open or not, is they are going to put enough people back in the workforce to give us the CPI numbers. The reason they're doing that, they're going to give us the September inflation numbers, is because the adjustments to Social Security are dependent upon that. So that is kind of one outlier that will show up this Friday. We also have the Fed meeting this week. So the market is all but sure that the Fed's going to cut rates 2 more times this year. The bond market has been wrong before, but we will find out on Wednesday whether Chairman Powell is going to cut rates again. Again, the expectation by the market itself is that we will see rate cuts. What was interesting, Brian, is one of those private data points that we got was that home builders, the sentiment among home builders has gone up. And at the same time, they have reported cutting prices over the last month. Isn't that kind of an interesting dichotomy in the real estate space?
It is. My only guess on that, Cole, is that with the drop in the 10-year Treasury, which is highly correlated to mortgage rates, maybe they're optimistic that lower rates mean that coming up in the next few months, they'll see more activity from buyers because we've seen a pretty big drop in that mortgage rate. So home affordability is improving. So if they've already cut their prices a bit for many of those home builders, and you're seeing lower rates, maybe that combination gives them a warm fuzzy because home builders are very knowledgeable about how sensitive consumers are to those rate cuts. You drop rates by 0.5% or 0.75%, you open up a lot of affordability for a lot of these families where obviously that's been a big problem with the spike in home prices post COVID, as well as the spike in interest rates at the same time. So time will tell, but that's one of those key parts of the economy, right? Home building, just home sales in general. We have a few stocks that are sort of dependent on that theme to an extent. So we're following it closely.
Yeah, and there was a big pullback in the regional bank space that you're talking about real estate and lending. This wasn't necessarily tied directly to real estate, but an interesting segue here that um, we saw a little blip in that regional banking space. Brian, do you want to explain what we saw last week there? And is this kind of a widespread canary in the coal mine situation, or is this a one-off? What do we see in there?
Yeah, it's there's some tough situations in this underlying economy that are starting to show up in different ways. And the regional banks is, it's one of those symptoms that maybe not everything is sunshine and roses, economically. And basically, what's happening is some regional banks are under pressure based on maybe it's commercial loans, maybe a higher risk of default on some of those underperforming loans. And if you think about it, a lot of commercial loans are office buildings, and there's been a huge evolution in how those spaces have been used and retailers. There's a lot of change still happening post COVID in that world. So you might see some people who stretch themselves buying properties in the last 5 years or so that maybe they're not getting all the tenants they need to support their commercial real estate, and that could ripple through to banks. It feels very different than spring last year, where we saw Silicon Valley Bank really hit the headlines and the Federal Reserve had to rush in and do some bailouts. And it sort of put a bit of a speed bump in on the Fed's plans to sort of shrink their balance sheet and keep the economy slowly easing off of their support. So far, we haven't seen that. That's the good news here is we're not seeing like mass defaults of banks. There's not a bunch of banks going underwater. The Fed doesn't seem to be panicking. I'm sure there'll be comments about it this week when the Fed shares its comments. But right now, not panic mode, but definitely a sign that there are stresses in this economy still.
Yeah, and from what I was reading, it was some poor lending practices, and actually where multiple banks thought they were in first position on certain loans. What was encouraging to me is we're in the early innings of earnings season right now, and there were 50 or so companies in the S&P 500 that reported last week, five of which were pretty well known regional banks, and they all beat earnings and raised guidance. They all had really good earnings reports. So these may have been one offs. Time will tell, of course. Also, we can't get much government intervention when the government's not currently working. So not sure what they would have done, if anything, if they were actually employed right now. So kind of an interesting rehash of, or revisiting of an issue that popped up last year that was kind of a potential panic moment for investors where they go, oh no, this is the beginning of the end. This is kind of feeling something similar to that. Is that how you're feeling with it?
Yeah, and maybe one of the things we learned last year is that there's resolutions for this. It doesn't have to be systemic. A few regional banks can have issues without the whole financial sector, being devastated. And it seems like whenever this happens, the end result is the big banks end up with buying assets from these small banks for cheap, and they end up winning. So it just kind of makes the financial system more concentrated. Maybe that's a risk in itself, but right now, not a reason to panic. But it is kind of what we've talked about, though. There are signs of slowing economy. There are signs that, again, not everything's perfect all the time. We see some stress on consumers. There's different parts of the economy that are still going to feel ups and downs. So not a reason to panic, but just a reminder that in this very complacent market we've seen the last few months, there's going to be something at some point that will rattle this market. And that's part of investing.
Yeah, and it is part of investing. Sometimes you're wrong when you enter into a position. Now, to be clear, we did not enter into one of those banks, and then, is not the position we're talking about. But say you did. We did have a position we entered into in one of our equity models a couple of weeks ago that had a downturn, kind of a bad headline, and just poor timing. Unfortunate. What can people do in their own investments? Something we're doing in client portfolios, something we're talking through in our equity position or our equity model right now, where we've got a particular position that's at a very short-term loss, but it's been a meaningful move. What can people do as part of their year-end tax portfolio strategy that we were talking through investment committee today?
Yeah, great question, Cole. And one of the first things we often talk about is don't let the tax tail wag the dog. So, for example, in the position we purchased just a few weeks ago, we saw an immediate decline related to tariff news that sort of blindsided us, hurt the stock. The first thing we did is we took a breath and we stepped back and we said, okay, why did we buy this stock? And are the things that we liked about it, are the reasons for the purchase still true? We like to look at the theme. What theme does this represent? What's the upside story here? What's the quality of the financials of this company? How are the fundamentals? So first off, we started there because the point of investing is to buy assets that you're going to sell at a future date or price, so that you can harvest those assets for a profit. Well, that still might be true, even though the short-term headlines might have driven the stock lower. Then the second thing to do is remember that a tax loss can be a tax asset. And that might sound like financial advisor speak, trying to make some lemonade out of lemons. And it is, as we try to twist a little bit and say, hey, we've got a loss here. We can use that as a tax asset. So that's kind of where we started the conversation. Then Cole, maybe you can take it from there and talk about, how we can sort of harvest that tax asset while still participating in the stock and getting the best of both worlds.
Yeah, so we still believe in the long term story behind the stock. Our proprietary numbers, growth rates look really promising going out a couple of years. So it's a position we still believe in, we still want. So that was your first point. So does the theme still stand up here? Is it still something we want to own in the long term? Yes. But we had a bad first couple of weeks in the stock. So what can we do if we want to maintain the position? Well, something we've done in the past and that we're considering doing again is we could actually we had a risk management tool here because this is a very high volatility stock. Its beta is over 2, meaning that it moves about twice as much as the market in any given day. So we knew this was a volatile holding. So what we did is we only entered into a partial position. So say our regular position is a 4% position in the portfolio. We only bought 2% because we weren't sure what the short-term ramifications were going to be in the stock. So we entered in half. That was a risk management thing and ended up being a wise thing. Could the stock have taken off and gone up after we only bought 2%? Yes, it could have, but we bought 2%, it fell down. So that was some risk management. We're only halfway into the position at this point. That 2% is only about 1.5% of the portfolio right now. So what we're considering doing is we can buy another 2%, or we can make it a whole position. We could bring it up to 4%. We could even establish a whole 4% position. There's no hard and fast rule here. The point is we could buy some more of it at a discount. It's 20-ish% off where we bought it. We could buy it at a 20% discount. We could maintain an overweight for a month or so. And then if we are still at a loss on that first tranche that we purchased a couple weeks ago, when that goes to 30 days, on day 31, we could sell that. So we avoid the wash sale rule. We could sell the one that's at a loss. We could have that tax asset that you mentioned, Brian. But all the while, we're participating in something that we really believe is going to go up, not only in the short term, but for the long term. So it doesn't make us time the market. It doesn't mean we get all out and we have to replace it with something else. We maintain the position that we have conviction in, with an eye towards the taxes, where we get to harvest that loss and take advantage of the poor timing on the first purchase. Is there anything you'd add to kind of clarify that? I hope I explained that okay.
Yeah, I think the idea is you get the best of both, right? We still get upside potential, but we can harvest the loss. And the key theme here, sort of the principle, is that when markets go down, you don't panic. You look into your portfolio and you say, okay, what's the wise decision at this point? Nothing you're talking about there is an emotional reaction. We're not kicking ourselves. No one got yelled at in an investment committee for suggesting we might buy that stock. We reassessed. We did what's smart from an investment perspective, and then we took into account the tax considerations, and we move forward, and I think that's one of the values of an advisor. It's very easy when you're making your own stock picks to become emotionally attached to holdings, either short-term or long-term, to get over enthusiastic or depressed when holdings are working really well or struggling. Whereas for us, we just look at the mechanics of the portfolio and say, okay, well, what options are before us and what makes the most sense, not knowing what the future holds, but knowing what we can control, which is we can control if we're going to increase or decrease the position. We can control the timing of that purchase to maximize the tax benefits, and we can control the risk we take by not letting that position become too great. So with those decisions in mind, we're moving forward, and What I love about this is we have our whole committee. So if someone's got a blind spot here or does develop an emotional bias, the rest of us are there to hold each other accountable. I'm glad we're not doing this on our own.
Yeah, removing that emotion is key. One of the research outlets that I listen to is really, really firm on they're just tickers. Remove the emotion, stop caring about them. Don't get married to some narrative. They're just tickers, and things can change, and you have to respond accordingly, no matter what's going on. So that is one of the beauties of the committee, and it's all part of this year-end planning. So that particular strategy, if you're going to have at least 31 days to then eventually sell and realize that loss this tax year, that puts your deadline to make that second purchase. If this is something you've got, maybe you have one of those regional bank stocks that really got hit hard, but you believe in it long term. I don't know. You would have until the end of, was that November 28th, I think, will be the last day that you could buy that next position and then sell before the end of the year on the first tranche. So keep that deadline in mind, because there are certain deadlines by year end for some of this tax planning. We've got a full day of Roth conversion and generosity tax analysis blocked off for next week, I believe it is. There's a lot that we can do. Think about Roth conversions. Think about making sure your RMDs are satisfied. Do you need them? If you're in retirement, if you're above 70 and a half, you could look at QCDs or qualified charitable distributions. Are there losses that you should harvest? This year, there aren't a whole lot of losses available in a lot of portfolios. I saw that the bond index is up over 7% this year. And most stock market indices are up, well into the double digits this year. Precious metals are up. Cryptocurrency's up. Almost everything you own is likely up, though there are some one-off positions, particularly in individual equity models where something's down. Areas to look at if you have a consumer staples stock or an energy stock. Those are two laggards this year where they're underperforming the broader market by a pretty wide amount. So if you own something in those spaces or you own one of those ETFs, those would be something to take a look at as potentially harvesting a loss. If you happen to be someone who has a loss, maybe a carry forward loss from a previous year, Brian, can you just touch on real quickly the idea of uh, capital gain harvesting? Most people are vaguely familiar with capital loss harvesting. What about capital gain harvesting? This could be a good year for that.
Yeah. So yeah, you get an up year, you don't have losses, but one way to take advantage of gains is to think about the timing of when you're going to capture those gains. So if I own a stock that I bought for $1, now it's $2. If I'm eventually going to sell that, the tax timing of that might be a consideration. If you're ready to sell it, if it's become too great of a position, a lot of reasons why you might want to harvest that gain. But you might want to take that gain in a way that's very intentional, taking advantage of tax brackets so that you're not bumping into higher rates. Some folks, if you're in the 12% federal tax rate on your taxable income, you can actually sell a long-term capital gain asset, and the capital gain tax rate on that is zero. You can actually harvest a profit and not pay any tax. For some of our clients, they actually shift highly appreciated stocks to their children, and the children sell those stocks as a way to help support them with education or lifestyle expenses, or just to be generous to the next generation. So rather than me selling the stock and paying 24% tax on it, I can give it to my child and they can pay zero. So there are ways to actually wisely harvest those gains that so many people are afraid of. Let's acknowledge that we've made some money on something. That's a blessing. And then let's be wise on the way out of that position by thinking about our tax rate, thinking about if I can get to a lower tax rate, or if someone I know can get to a lower tax rate, that I would love to benefit from this resource.
Yeah. So we've covered a lot today. Brian, how would you summarize what we've talked through? Is there a call to action that you might offer to anybody watching this right now?
Well, as always, seek wise counsel. If these concepts are overwhelming to you or foreign to you, that's a sign that maybe having a professional walk alongside you, that could be a wise choice. For those who already have folks like us helping you out, it's a good time just to have a conversation. So go out and have a tax conversation now with your tax advisor, your financial planner. Don't leave opportunities on the table just because we're about to get into the holidays and things will get busy. And then just be patient, be wise. In terms of an investing point of view right now, I'd say there's going to be more volatility ahead because that's the way markets work. Don't panic. Just know that there's going to be bumps and don't get caught up in the headlines.
Yeah, that's a good place to end. So thanks so much for joining us on the Wealth and Wisdom podcast where intentional planning meets eternal perspective. If you found today's conversation helpful, please like this video, subscribe to the channel, and share it with someone who would benefit. For more resources just like this and timely insights, please visit our insights page at johnmoore.com where we regularly share articles, videos, and tools to help you steward wisely. And we look forward to seeing you all again next week.